Hello, and welcome to the Crypto Beat. My name is Kelvin Sparks, and this is my co-host, Tim Copeland, Head of Growth at The Block. Joining us today, we have founder and CEO of Chaos Labs, Omer Goldberg. Welcome to the show. How's it going, man?
Hey guys, thanks for having me. Longtime fan of the show and excited to be here today.
Yeah, thank you for joining us. And before we get started, I just quickly want to note our crypto IQ test is now live. Go to theblock.co/crypto IQ to take the test, showcase your smarts, and complete for 20K. We also want to note that if you're tracking the crypto treasury trade, we have some fantastic charts on our data dashboard. Make sure to go check this out. Go check those out. Now, on to today's episode about DeFi, risk, and chaos AI. So really, before we get started, Omer, I kind of wanted to talk about your background, which is really interesting because you came off very tech-focused, really AI specifically, Facebook and Instagram. I'm kind of curious, like what got you into crypto initially?
Yeah, so I started getting really interested in Bitcoin around 2013. So I was just in college mining Bitcoin with my roommate, actually Jonathan, who's today the chief scientist of Chaos Labs, and got really interested in the technology, the cryptography, just different decentralization models as well. But really, at the same time, there was no kind of breakthrough like application. I think a lot of like the meta was we're going to do Uber on the blockchain or Facebook on the blockchain, which was pretty like uninspiring. So really kind of kept close to the space and doing a lot of open source development and technology. And 2016, I joined Facebook. I worked for 2.5 years in Africa, where we were building internet infrastructure for emerging markets. So Kenya, Zanzibar, Tanzania, South Africa, Ghana, Ethiopia, and more. And that was really the time where, for the first time, I was exposed at scale to electronic money. So, like in many of these regions in Africa, they're either completely unbanked or underbanked, which means they only have access to a subset of financial services. And they have things like M-Pesa there. Basically, since there's no bank in like a 100-mile region, they go to their local teller, deposit cash, and they're credited on their cell phone number with credits. And then if you want to get like a service, like in the village or in the city, you text credits back and forth. So seeing that was eye-opening for me. And then when kind of Psy and DAI became a thing, realized that money was the killer use case for crypto. Started looking really heavily at the space. And 2019, 2020 took the full dive back into crypto when DeFi was getting started.
Nice. For crypto and DeFi professionals looking to contribute to a team committed to innovation in digital assets, Fidelity Investments is now hiring. Why Fidelity? For starters, they've been exploring Bitcoin and blockchain since 2014. They were the first traditional asset manager to launch a native crypto business and amongst the first to launch a Bitcoin exchange-traded product. Innovation is in their DNA. Fidelity invests in their talent by supporting and developing associates through continued education opportunities, casual crypto-focused discussion groups, and on-the-job experience working with new technologies. If you want to work on cutting-edge products and explore the new frontier of DeFi and blockchain, Fidelity is for you. Fidelity's products continue to improve and evolve, staying ahead of this rapidly changing digital asset landscape. Explore Fidelity Crypto Careers today. Go to crypto.fidelitycareers.com to learn more. That's crypto.fidelitycareers.com. Fidelity is an equal opportunity employer. And I'm curious, could you speak to a bit more about how your initial interest in crypto led into founding Chaos? Like, what were you seeing in DeFi that really perked your interest?
So it was right before DeFi summer and through DeFi summer, volumes and TVL in the space were exploding. And during my time at Facebook, the first 2.5 years was at internet.org. The latter 2 years were at Instagram and Facebook. And I think one of the things that are really special about Instagram and Facebook is, despite being a consumer product, it's one of the most rigorous data science cultures in the world. And what that means basically is every single update that is shipped to production is A/B tested. And they can do that really well because they have a few billion users across like WhatsApp, Messenger, Facebook Blue app, Instagram, and a few of their other applications. And I was looking at DeFi, I was seeing all of these parameters on the applications that had massive impact on the returns, on the risk, on the security of application, and just reading the code and going through the forums and the discords and seeing that everybody was kind of eyeballing what they should be. And just like with the amount of capital that was there, I knew it was wrong. So the first instinct was, well, it'd be great if we could test in production, but this isn't social media. We're dealing with money and value, and you don't want to tell someone you liquidated them because they were in the wrong experiment group. So the next best thing you can do is high fidelity simulations. So really, like the idea was, can we take the rigor and the data science, the data-driven decision-making frameworks that we had at an Instagram and Facebook and bring them into this new world of finance and make automated prescriptive recommendations for how to configure these applications in line with real-time market conditions. So that was like the inspiration.
Awesome. And really, I guess since then, you've gone on to process trillions in transactions via risk oracles with, you've also written extensive research on bleeding edge DeFi and actively monitor risk for large protocols. How did you get to this point once you realized like this was going to be your bread and butter?
So trillions, not only with risk oracles, also with price oracles. So for example, today on Jupiter on Solana, we're the primary oracle for the whole perp exchange. So we have risk oracles, price oracles, and proof of reserves. Basically, like all the data any application needs in order to be kind of secure, efficient, and have like a good UX. And really, the path to that was we spent like the first year and a half, 2 years training all of these AI and machine learning models. We used like a methodology that's called agent-based Monte Carlo. And that was great. We had these dashboards, but still there was this huge burden of work on all of the applications. So if you were an Aave, for example, you needed to go to the dashboard, you needed to copy and paste the values that were emitted from the models. And then you had to create a Solidity payload or Solana payload if you were deployed on Solana, maybe get it audited and deploy. And A, operationally, that's a huge burden. But B, it meant and it still means that de facto everything was being run manually. And this is really bad in anything that's like risk or security related. You want to be kind of proactive. You want to be real time. And we realized the insights that we were providing, while they were valuable, they weren't nearly as valuable as they could be if they would be actionable. And really, for us, the Oracle was a way to do that. So we wanted a way to be able to deliver our data, our insights, our actionable recommendations on chain in real time, which led us to building the Chaos Oracle.
Understood. And really, I guess one of the things I kind of want to highlight is for people who aren't as quantitative, how would you describe risk in a DeFi context?
Yeah. So if you're doing anything on chain, you're coming into contact with it like every day, whether you know it or not. And just some examples is like liquidity risk. So even last night, I think this is kind of trending on the timeline, the hyperliquid XPL market, right? So suddenly you have a market that where the price of the perp will 3x in like 90 seconds. And the reason for that in this case was liquidity risk. So there just isn't a lot of liquidity like in this market, and it's very easy to move the price. When there isn't a lot of liquidity, that also introduces volatility risk. So you have an asset that is super spiky and can jump up and down. Interest rate risk. So if you're doing anything in DeFi, you're likely in one way or another trying to generate some type of yield. A lot of that yield is downstream of understanding how to configure interest rates as a function of supply and demand. And this, if you've been in the space for any time, is kind of touching everyone, is systemic risk. So one of the great things about DeFi's composability is that all of these apps can kind of be built on top of each other because it's open source code. But if one of those important Legos blow up or something goes wrong, it has cascading effects on the whole ecosystem. Probably the most famous is Terra on-chain, which many applications were using USC at the time as collateral. So no shortages of risks, and they just kind of fall into different taxonomies.
What did you make of the hyperliquid plasma thing that happened yesterday? Like it seemed that they made some sort of changes in response, but I'm not sure if I fully understand the situation. Can you sort of shed any light on it?
Yeah, so the situation is that Hyperliquid provides what's called like a pre-market. So there are assets that their spot is not yet live and not yet launched, but folks still want to like speculate on the value of it or what it's going to be when it does launch. That's one use case. Another use case is hedging. If you have access to the spot, the pre-release, like a lot of people do in the pre-sale. So there was a market for that. Now, typically, like there's this arbitrage that happens between perp markets and spot markets that keep the prices in line, right? So And in effect, because there's this arbitrage, it increases the cost of moving said price, because now you need to move it across all markets. But here there was no spot, and one trader came in, did a really, we can kind of discuss, is it a trader, is it an exploiter, kind of a different discussion, but like opened up a really big trade, a really aggressive long that moved the price of XPL on those markets 3x in about like 90 seconds, 120 seconds, and liquidated millions of kind of people who had short positions open. And the issue here is the cost of doing something like this. So it cost them under $1 million to open up a long, which liquidated orders of magnitude of that. So that is what happened. And I think in response to that, there are many levers that you can pull to kind of make the market safer. Typically, like risk in one way or another is some type of trade-off between like leverage and kind of capital efficiency and security. Like what is your exposure to like the market and like how secure are you? So they're tightening a bunch of those, but I think there's still like an ongoing discussion in the Discord. And pre-markets are tough because you don't have that kind of spot market. You don't have a lot of the kind of these mechanisms which kind of balance the price and increase the cost of manipulation. On the other hand, there's demand for it. So it's an interesting design space.
Okay, and if like Chaos Labs, if Hyperliquid had integrated with Chaos, would it? Do you think you would have helped, inform people about what was going on, provide any sort of risk mitigation?
Yeah. So I kind of actually like wrote a thread about it and posted it like a few hours ago. But basically, with risk oracles and our price oracles, and really we see kind of like risk and price as the same thing, right? Especially in this case, you don't want to just like blindly take like the middle of the order book, because otherwise you're susceptible to these type of things. So there are different types of things you can do, like exponential moving averages, have some kind of relationship between the weight of the movement and the depth of the order book. You have all these different techniques that the goal of them is to kind of slow down the movement of the price on these pre-markets and just make things like a little less instantaneously like volatile. So we propose like a few solutions to do this. Some would argue that like this volatility and these kind of thin markets is like you no crying in the casino, and you kind of get what you pay for, like in the sense. But there are ways to kind of make sure that mass liquidations reflect an actual kind of a genuine movement in the price versus like a single whale that's able to push something up unproportionally with a small amount of capital.
Yeah, it makes a ton of sense. Things like smoothing weighted, like you said, volume weighted average pricing, that kind of stuff.
And centralized exchanges have that, right? Like the NASDAQ, they have like, I don't know if we want circuit breakers, but there's like a spectrum of things you can do, right? So like in the, like NASDAQ, I think if something rises like over 5% in less than 20 minutes, you stop the market, right? Because there's some abnormal like movement. So there's a spectrum.
Yeah, that makes sense. And I guess kind of interesting point that brought up as part of this conversation was, do you think that risk has evolved as we've moved from traditional finance rails to blockchain rails?
I think a lot. Like if you look back to 2008, as an example, there were many things that were wrong with like the housing crisis. But I think one of the biggest things was nobody knew what their counterparties had on their books, right? And I think in the world of blockchain, in theory, you have symmetrical information, or at least a lot more information, and you can model these things in a way that's a lot more transparent and accurate, right? So that is kind of like a big thing. The other thing, though, or the flip side is that in the world of blockchains, we have risks that don't exist in TradFi. So things like flash loans, like flash liquidity, asynchronous execution and block times, MEV. So it's definitely changing. Some of it like looks and feels the same, but the underlying technology is different.
Yeah, it makes sense. And I guess it's funny. I used to hear people coin it like I think maybe it was like Bitcoin was the death of counterparty risk. Do you think that's like a true statement?
Um, what were they meaning by counterparty risk?
It was just like an old, like the whole idea that you could be your own bank that was like in the Bitcoin community in a sense, like, well, since there's no central authority involved, this is now like, I guess, the evolution of finance. I mean, I get where they're coming from with that statement, but yeah, just curious what you think.
I would say that in many ways, like a smart contract is the death of counterparty risk. Like if you're doing it correctly, you don't need to like depend on the counterparty to hold up their end of the bargain. But I think then the other counterparty risk that you get is that there's no KYC or AML. You don't know who's on the other side. You don't know if the funds that you're touching could be tainted, or there's an issue in offboarding them because they're coming from a protocol that's tainted. So I think net things are way better. Like when you can see everything that's happening on chain, it kind of lays the ground for far more equitable like outcome. But there are also new risks that are introduced.
Understood. Yeah, well articulated. And one of the things, I guess, now since we spoke from like a much broader scope, for the people at home, maybe people who are new to crypto, retail, people who want to start messing around on chain, why is it important to manage risk even at a small scale?
So I mean, for retail, I would say that it's important to manage risk to not get wrecked. If I had to like say it simply, and it's also like a UX thing, right? So I'll say that like there are trades where I'll give an example for a retail user that's trading perps, and you get liquidated, and like fundamentally you took the wrong side of the trade, and it moved against you, which is not fun, but you can live with. And then there might be cases like I don't want to over-index on like the hyperliquid XPL thing from yesterday, but I guess we can run with that example where it's like a single person that completely moved the market and liquidated you, and not necessarily like a representation of the true price, just like an opportunity to kind of drive self gain and a large payoff with a relatively small cost. So you want to basically like kind of mitigate those situations for for a more equitable outcome for everybody and just general better UX. You don't want to get caught like on a wick that happens on a single exchange, or liquidated on some asset or price feed where the price that was written didn't represent the real price in the market.
So I was curious, like, kind of speaking to more so DeFi while we have you here, like, and specifically protocols, like from a protocol innovation perspective, has there anything that's interested you recently or mechanism design that you've really taken a liking to?
There's a lot, I think, coming out here, and like a few step functions. I've been spending the past few weeks a lot like with the Pendle and the Boros team. Those are two things that come to mind. So just being able to introduce the PT risk oracles, and for the first time onboard derivatives into Aave. Derivatives are obviously massive markets in traditional finance, and for the first few years of DeFi and on-chain finance, we didn't have them at all. That is like one of the fastest growing markets, and it's only possible because of innovations like on the protocol level, on the oracle level, and like everything together. So that is something that is like really finding product market fit. Boros introduces funding rate swaps, also huge markets in traditional finance. Didn't really exist, at least on that scale, yet in DeFi. That's big. And if I had to pick, I think one more, I think it would be like related potentially to stablecoins, like proof of reserve oracles.
Understood. And I guess one of the things I kind of want to talk about is the larger DeFi ecosystems would be obviously Ethereum has most of the TVL by chain. Recently, I mean, there's been an explosion in institutional interest, and there's been prices also been soaring. I guess, is this a signal for the DeFi sector at large? Curious what your general thoughts are with this renewed institutional interest.
Yeah. So I think a lot of this interest is being driven off of the momentum of stablecoins coming on chain and all of the great things you get from stablecoins. And I think Ethereum has been like the designated L1 for this for a few reasons. I think liquidity and TVL dominance kind of come together. So liquidity just has this like network effect to it. So institutions start kind of deploying capital into Ethereum, and liquidity begets liquidity. So that's one aspect. Same for TVL. The others would be, I think, just risk. I think when we talk to every institution, um, they think the blockchain is cool and all of these things. But the first thing that they're most concerned about is like the security and risk of the assets and the well-being of their users. And just being able to kind of make the case that we have risk and security infrastructure on parity with TradFi, and in some cases better, is absolutely necessary. Like nobody's looking to kind of like migrate to an environment in which their users could experience financial ruin or kind of lose funds. So that's definitely matured. Um, and I think the administration is also helping, the Trump administration and being pro crypto.
Yeah. And you kind of spoke to the stablecoin narrative as being one of the main drivers for growth. It feels like, at least right now, almost like that technological innovative moment for at least stablecoins specifically as a sector. Curious, do you have any general thoughts there on why? I mean, you kind of spoke to a bit as to why people are flocking to it, but you could expound a bit more, like, is this going to be sustained and why you think so?
Yeah, I mean, I think the stablecoin, in my mind at least, and like in the conversations that I have, what stands out is just like the margins are better. Like a lot of these banks, a lot of these fintechs like operate on rather thin margins. They're slow. There's like a lot of back office operation. With stable coins, you take all of that away. You have 24/7 global instant settlement at like pennies on the dollar for like moving anything. And that is the motivation. Like all of the decentralization and it's cool. I don't think that for most of these like multinational banks, that is necessarily what's driving the needle. So I think there's good reason to see it kind of to see it grow thus far and for that to continue to grow. And then like I think we also have a generation that is kind of demanding these solutions, right? And demanding like instant settlement, 24/7 availability. They want more control over their money. So you have it coming from both sides. One is just like the margins are better. We can make the business more efficient and we can grow. And not doing so poses a risk for us in our future. And second is users want it, because the second one bank has it and you can move money on the weekend and do all these things, and you don't want to be left behind. So I think that's pretty strong, and we're going to see this continue to grow.
Okay. And where in the DeFi stack do you see the greatest hidden risk today?
There's, I don't want to be the bearish person, but there's risk at every like layer of the stack. I think that from a smart contract perspective, like for many of these primitives, we've converged on like architectures that are just battle tested and proven. So Aave is a good example of that. It's been around for many years. It's processed tens of billions in on-chain credit, loans, liquidations, and all of these things. So that is kind of to a certain extent being mitigated, and there's some lendiness to that. There's operational risks, like how you manage your keys and the degree to which a single entity or has like power like over like a protocol. But I actually think that today it's oracles, right? It's oracles, but not only price. And when I say oracles, I mean all of the data that we bring from the external world. So you can take any L1, any L2 that you want, even any app chain. But you need to be able to connect it to the real world for it to have utility, to be able to put RWAs, to put stable coins, and actually being able to control or influence one of those oracles in an adverse manner introduces systemic risk throughout the application. So getting that right and also being able to take the jump. Like the first generation of oracles were super, super simple. We were taking just basically a median price of these large cap assets, primarily like a Bitcoin or Ethereum, and putting them on chain. But in speaking to these institutions, the requirements are way more sophisticated. There are different derivatives that they want. They want bridge assets. They want different data points. All of this stuff needs to kind of run in sync. And this is like, I think, the next big step function, where we can kind of provide the same level of sophistication, financial instruments that exist in TradFi on chain.
And if you could rebuild DeFi from the ground up, what would you change?
In retrospect, there's a lot. I think just on this call, the first thing that comes to mind is performance. Um, it's easy to say in retrospect, but I think that like the lack of scale of a lot of these L1s necessitated these different L2s and side chains and app chains. This really kind of hurt the overall UX and increased the complexity of the space. So I think that's definitely like one of the things that I would, um, if we could go back a decade, spend more time like working on and potentially contributing to.
Oh. And is there anything you track that no one else is sort of paying attention to in terms of like risk metrics?
I mean, I think a ton. I think that like one of the ironies of blockchain is that it's open, and in theory, there's information symmetry. You can get like a lot of information. In reality, today, not that many people know what's going on. So I'll give an example. If I asked you what happened in Ethereum in the past hour, that's really not a question that people can like answer well. You have maybe like on-chain sleuth or detectives that will like go into Etherscan and could pull it out, or a specific kind of dashboard. But generally, it's really hard to know, and you can extrapolate that for a lot of different things. If you say, "What happened in Uniswap?" Unless you have like a specific kind of application that someone engineered, it's hard to know. So we look at everything from segmenting different kind of wallet clusters and users to on-chain liquidity, depth of the liquidity, uh, price discovery. I think the next kind of, and that's one of the things that Chaos AI really aims to do, is to kind of surface a lot of this information in a way that's digestible. So like, you shouldn't need to have like a PhD in blockchains to understand how much MEV is being extracted on Unichain, for example. These things should be kind of easy to query. But there's a lot of data plumbing, data infrastructure, and a lot of fine tuning that you need to do on this generation of language models to be able to get that in a way that's digestible.
Understood. And on the topic of chaos AI, it's pretty interesting given how much data like you guys are ingesting via your price oracles and risk oracles. Obviously, we spoke to the trillions. I believe it was like 3 trillion in transactions. Like, how are you able to sleep at night knowing that these systems have to be so highly available and just like fault tolerant?
Yeah. So sleep in Chaos Labs is not such a great combination since I started a company, but um, I mean, we've built all of our systems with resiliency and redundancy, safeguards and guardrails at the forefront of everything. So it's like security in depth. There's not like one thing that can hurt the system. And we spent years like building all of these systems out, uh, testing them, and really putting them. Um, I think like DeFi production actually provides you with like edge cases and black swan events like every week. So it's just a lot of discipline like over time. And I think separately, like the team's background is working before Chaos Labs on defense technology, the most lucrative like application surfaces in the world, and just like mission critical software. So it's really like a cultural thing, and just over time, it doesn't happen overnight.
Yeah, it makes sense. And I was curious about how like the wealth of data and battle tested systems you guys have built will be used to power the next generation of like businesses. I mean, specifically you spoke to Chaos AI, so curious how that kind of all ties together. If you could speak to that a bit more.
Yeah. So before the solution is just like, what is the gap? So if you do either of you use like ChatGPT or Perplexity or any of these in your day-to-day workflows?
Yeah, absolutely.
Cool. So if you like, I'm sure you already know that they're not, there's a real gap when you're trying to use them in finance, and more specifically, when you're trying to do anything that's like quantitative or that requires computation. Language models are not good like at doing math. And then when you get to blockchains, that like they don't really know at all like what's happening. I think the only case they would know is if they've indexed an article from the block or like another website. So these things kind of show a lot of promise, but there's two kind of gaps. A, they don't have the data. So usually like language models have knowledge cutoff dates. So they're trained on the pre-training is on the whole internet to a certain date. Afterwards, they're connected to the internet and real-time events with search engines. But when you think about search engines, so if you're getting like an agent, like a search tool, like Google search, well, Google search doesn't see centralized order books. It doesn't see global leverage on option markets. It doesn't know what's happening on OTC. It certainly doesn't know what's happening on chain. So there's a big gap in the data. Then even if you have the data, the model doesn't really know how to reason about it. So a lot of that data is quantitative in nature. It's very confusing for the model. And I think the analogy that like I give to people who join the company is like, even if you had a really good data set today in blockchain MEV, for example, and you gave it to GPT-5, the analysis that you would get is akin to like a very smart biology PhD. So like maybe they'd be able to kind of extract general like insights, but it's very, very different than if they would take it to chaos or the block research and really sat with someone who had subject matter expertise. And the way to kind of bridge that is to fine tune and train the models. So you need both of these things. And once you have that, then you can unlock a trove of data and insights and make it really accessible. I'll just end with saying there's this concept of like emergent behavior in models. So like emergent behavior means that you're training the model to do X, but it turns out it's really good at A, B, and C too. So maybe you train like a language model like ChatGPT to answer QA, but it turns out it's really good at creative writing. And when you look globally at different verticals, finance being one of them, but also medical, also legal, also accounting, all of these different things, being world class in those is not emergent behavior. So you're not going to get it for free by training it again on the whole internet data. You need domain specific data along with domain specific expertise and to really kind of sit and train the models. And once you do that, then you have something that's extremely valuable.
Understood. And with these like emergent behaviors, like what are the implications of these AI agents being unleashed in like the DeFi ecosystem? Like, will they be rational actors?
It depends how you train them. I think that like with all of the cool like kind of demoware that we've seen to date, we've only seen a fraction of what's possible. I think the next generation of financial on-chain agents are going to be way more powerful. But I also expect there to be like a process of trial and error where people are going to kind of try things and think that it works and realize that some of these agents don't have the necessary guardrails and can be exploited. And there's going to be like cycles. This is like, we're breaking new ground. And similar to the path that DeFi had to do as a new technology and all the lessons learned, in any kind of vertical world, you're going to see the same. But in finance, you have to be more careful because you're dealing with value as a first party.
Over the years, when I was a reporter, I can't tell you how many stories we did about DeFi exploits in crazy numbers. There was a point where there were exploits. It was every week, typically every weekend. They were just always on, like a weekend when everyone was sort of distracted. But it feels like we haven't had that many, or like it's sort of tapered off. And is this because, like, security is all really tight, or we have better risk management, or they've run out of money to steal, or like, all the sort of vulnerable contracts have been exploited? Like, what's the sort of reason for this?
So I'll say two things. I know that in the past was certainly bad. I wouldn't say that now is great either. Like I think maybe we feel it because it's like our business, but there's almost something like every day. There's so many networks, there's so many L1s, there's so many L2s. So things are busy. Perhaps though, it's been many years since we've seen something at scale fail, like UST on chain. I think it's a few things. It's not because of the lack of there's what to steal. I think you have very motivated groups like Lazarus and other nation state actors that very actively work to do this. So there's no lack of motivation, but I think a lot of the low hanging fruits are no longer exist today, and I think there's a convergence of standards. So, like we said, a new lending protocol is typically not building directly from zero. They're kind of branching off from some architecture or some set of smart contracts that have been in production or tried and true. And The security culture has gotten way better. But security and risk, especially here, are always going to be really tough because it's a asymmetric game. So that means that like a team that's deploying like a new application can be 99% perfect, but it only takes that 1% tail to destroy a ton of value. The second thing is when you look at TradFi, this isn't a great security model, but it's one that exists. A lot of the security is security by obscurity. So that means that like you can't see what's running on JP Morgan servers. You can't see what's running on Bank of America servers. But with smart contracts, you can see everything. And I don't think there are any other systems, these financial systems at scale, that kind of have this amount of asymmetry. So we're getting better, but I think it's also a lot harder to do this right in Web3 than it is in Web2.
Okay, now onto stablecoins. Correct me if I'm wrong. I believe you guys work with Athena, right?
We work with this Athena, AUSD, USDT0, a bunch more too.
Do you think there's any risks with the sort of stablecoins that you see today? Obviously, you mentioned UST back in the day. Do you think there's anything we need to be worried about right now, or is everything pretty secure and safe?
Yeah, I mean, there's in any market, there's always baseline risk, but I think that the stable coins that we see today that are growing are fundamentally of a different kind of caliber and a different just model and design than what we've seen in the past. Algorithmic stable coins are a different beast. And I just think it's a lot of the infrastructure has been put into place to make sure that these things are safe under stress. So yeah, I mean, but it's a 24/7 job, right? Like you have unsung heroes across the industry on the security, on the risk, on the economic security side that are working constantly to monitor things. But I would say that's no different than also just traditional finance.
So actually on that note, what are some of the like different like high fidelity stress tests you'd run against a stable coin just to ensure that it's going to maintain its peg?
Yeah, so a lot of the stable coins basically come down to like what is backing them. So this looks different if it's like an RWA backed stable coin versus Athena versus something that's a mix of them versus something like DAI, which is collateralized debt positions. But basically, this is what we do is called like Monte Carlo. So we run a bunch of simulations with different price trajectories, different levels of liquidity, different levels of kind of volatility, user concentration. And what we want to show is with very high probability, even under the most chaotic scenarios, this instrument is stable. And that's actually where the name Chaos Labs comes from. And the way that we think about it is like, hey, if we can ensure with high confidence that this instrument, this stablecoin, this tokenized money market, whatever the case is going to be, is still resilient under stress, then we can be pretty confident in the spectrum leading to that. And that's just via a lot of simulations. And that's the core of kind of the risk oracle engine alongside the AI modules, which also pipe more qualitative like text signals.
If you had like a stable coin that was going to collapse, are there ways that you could sort of monitor the risk there and sort of help to safeguard users?
Yeah, you can definitely like there are different methods for like gauging like what the harm would be. Ultimately, like there's a lot of variables in that, and when things go, so you can like there are a lot of methods for like estimating it. But I think what's different today is that there are also ways to act on it proactively. So I think a good example of what the world looked like without those dynamic risk levers is the USCC DPEG. So like, it was like I think maybe 2 years ago at this point, SCB collapsed, USDC was depegging, and this was still a stage of DeFi where everything was kind of done manually. So as an example, at Aave, for any kind of governance, for any parameter change, it was required to go through a full governance cycle, and these contracts had a time lock. So we saw everything happening in real time. We couldn't change anything. We're basically sitting on our hands until the time lock expired. Luckily, SVB got bailed out. But today, we could actually respond to that in seconds on a lot of different levels. So there's guardrails, there's the ability to optimistically change parameter settings and in line with a kind of a pre-approved governance framework. There's just a lot more levers that we can do and let us be really proactive versus being solely reactive.
Understood. And I guess, yeah, that's all the time we have for today. I want to thank Omer for joining this episode. And as a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the block. Thank you, and see you next time.